upward here. So if you're looking at this chart, we don't know what's necessarily going to happen next with any 100% certainty, and you can't try to pretend that you're going to get 100%. The only way you're going to be 100% certain that the market's going to go up or down is if you got a number early and you know what that number or the miss is going to do, and you got it early, or some sort of comment out of the Fed that you know is really bullish or bearish, and again, you got it early. And you could pretty much say with closer to 100% certainty we're going to go down or up on that bullish or bearish economic release. Well, we don't have that, but what we're looking for is if indeed there's going to be resistance, and if you're going to use, let's say, this green dotted line that we have, which is where the average price of where longs are long from in the last hour. PWAP stands for position weighted average price. The shorts are the red line. So if you're thinking and then using this as an area where price is going to go up to, not go through and eventually curl back over and head down, then you're playing this from the short side. That's the way you have to look at it. You don't necessarily leave an offer in the book to get short right there. Then you get filled, life is good and goes down. Leaving offers in the book to get short's not going to work with any kind of consistency. You're fighting for the position. Now, you're not bearish and bullish in the same 3 seconds. You're on one side. You already have a ready aim fire kind of in your progression. You have a ready aim, at least, with your bearish, and you're going to use the green PWAP as potential resistance. That's kind of your aim. What's going to get you short? What's going to get you to pull the trigger? And this is I won't say a mistake, but a kind of a weakness in most people's trading until they're kind of understanding how everything's got to get broken down, and you really need to have a ready aim fire approach. And you just can't have the best resistance in the world. You've come up with prices that give you great support and resistance, and you're frustrated because you still can't be consistent. And it's because oftentimes you miss the winners but catch all the losers. Let's say you're trying to offer it right here and it trades 9 contracts, doesn't fill you. But if it did, you would have made money. It would have been a winning trade. So there's a winner, but you're not on the team, so it doesn't count. Well, guess what? If you laid the offer in the book and it didn't work, you'd have got them and you caught the loser. So you catch almost all the losers and not all the winners. So you have to have a qualifying or disqualifying tool, and then you could approach it that way. If you just look at the laser, which we show it there, and then also right next to the footprint chart in there. So if we play this, you're going to want, let me pause it again. You're going to want, when you're looking to fight for a short position, you don't want other people short with you. You got to know that, and you got to know why you don't want other shorts with you. In fact, you want a lot of people opposite you. You want people long when you're short. If you listen to enough of my videos, you know why. And so the green line that we also call the laser, when it's green, it's showing there's more longs than shorts. Not that there's a lot of longs, because that's relative. It's relative to what? There's a lot of longs if there's not a lot of shorts. So you got to compare something to something else to find value. So if there's a lot of longs, because compared to shorts, there aren't many, you start to get the line to go green, and then it gets longer if more shorts are piling in. That's what you get right here. You don't get it necessarily at the very top, but you get the red. If we back it up right there, you do get the red line to shrink, which means there's becoming less and less shorts. So you play it, we start to roll over and break a little bit. You'll see the shorts diminish. Boom, right there, it does go red to green. So it's that first flicker that puts you in a position to fire and qualify potential resistance. Best locations are going to be when it does this after you execute. Then go straight to your target, although that's nice, but it goes your way as soon as possible. And you can see the market go in the direction you anticipated and it doesn't feel like you got lucky or feel like a good guess, which it's also not going to be, or you're going to find any consistency if it feels like a good guess most of the time you put on winning trades. There's got to be a sense of probability. You knew it was going to rain this afternoon because of XYZ and it rained this afternoon. You didn't tell people it was going to rain after they're wet because that's like saying, hey, that was a great short up here right now. That's like saying it's going to rain after you're wet. But if you could understand why this flip from red to green creates a probability that that's the win moment, now you're qualifying and you've got a more complete plan.